Okay, this is a video in lieu of your class that is being canceled on February the 9th due to the delay in opening Cabrini University. So we're going to cover the material that we would have in our class on February the 9th in this video. So let's go ahead and get started. Now, what I have here is the last slide that we did review in class, in our last class, and what this was an example of how value, or if you will, cost, flows through the balance sheet, raw materials, work in process, and finished goods accounts, and then eventually ends up in the income statement under cost of goods sold. And I did several transactions to illustrate this. We started out again, remember the equation, beginning inventory plus my inputs or additions minus my outputs equals my ending inventory, and that's true for raw materials, work in process, and finished goods. And you can see when I transfer raw materials, the inventory flow in terms of dollar value flows along with the physical flow of the inventory. So I start out with raw materials and they get transferred into work in process. And then I add my direct labor and my indirect costs that are associated with making that product. And at the end of the day, then I transfer those items that are complete out of work in process and I transfer them into finished goods. When I sell the finished goods, they are transferred into the income statement on cost of goods sold. So let's take a look at the next slide and take a little bit deeper look at cost flow and inventory. Okay, in our last slide, we had seen how we moved cost, the cost through our various balance sheet and inventory accounts. Here, what we're going to do are use those same exact transactions that we used in the previous example, but in this case, we're going to move the value utilizing our general ledger accounts. So you can see here we have 4 balance sheet accounts. We have cash, and cash here for our purposes is just used as a balancing account. But more importantly, we have raw materials, work in process, and finished goods. Also, we have income statement accounts, which include sales and cost of goods sold. So again, let's assume that the beginning balances of raw materials, work in process, and finished goods are all 0. So we know we're accomplishing that, so I'm just cross that one off. The next item is purchased $500 worth of raw materials, and we're going to assume that the purchase was made in cash. We don't want to use accounts payable or any other payable accounts. Just let's keep it simple and call it cash. So we purchased $500 worth of raw materials in cash. The debit would go to raw materials for $500 and the credit would go to cash for $500. Now we're going to take all of those raw materials and transfer them into work in process. So we're going to credit raw materials to remove the value out of raw materials and transfer that with the debit to work in process. And you can see the entries right here. And what we see then is when we total our debits and credits up in raw materials, now the raw materials account has a balance of 0, which it should be, because that's what we transferred out of our account, the entire amount of raw materials. Okay, then we're going to go on to entry number D, and it says paid $1,500 in cash for direct labor costs for converting the raw materials into finished goods. So we've hired some people, we're paying them cash, and they're converting those raw materials, or applying the labor against it and converting it into eventually into finished goods. So what we're going to do is we're paying them $1,500 in cash. So that's going to be added to our work in process. We're going to debit work in process for $1,500, and we're going to credit cash for the amount that was paid to them for $1,500. Okay, now we're also going to record all the indirect costs that were associated with the goods that were being worked on. So we paid $2,000 for indirect costs, and later on we're also going to be calling this factory overhead, or simply overhead. Right now I'm calling them indirect cost. A little bit later on we'll just refer to them simply as either factory overhead or overhead. So we paid $2,000 of indirect cost in cash, supporting the conversion of the raw materials into the finished product. So in this case we're going to debit work in process for $2,000 to recognize the amount of indirect cost we've incurred when the products are going through work in process, and the credit goes to the amount that we paid, and that's for cash for $2,000. Okay, now we go on to entry number F, and it says we've transferred all of the products in work in process to finished goods. That means we have no remaining work in process inventory. So the entire value of work in process, which is going to be $2,000 plus $1,500 plus $500, which is $4,000, that whole value is going to get transferred into finished goods. So we debit finished goods for $4,000, and we credit work in process for $4,000. And again, when we add our debits and our credits together, we have a balance of 0 in work in process. And the last entry now is we sold all of our finished products for $10,000. So again, the value of our finished products is going to get transferred now to cost of goods sold, because we sold all of our finished goods. So the entries are there's actually going to be two entries here. The first one is the recording of the sale itself, and the second one recording of the movement of finished goods to cost of goods sold. So we're assuming that we're selling this for cash. So we're going to debit cash for $10,000, and we're going to credit sales for $10,000. So that's the first part of our entry. The second part of our entry is to take the value of finished goods and move them to cost of goods sold. So we debit cost of goods sold for $4,000, and we credit finished goods to remove the value cost of goods sold for $4,000. Now in finished goods, our debits equal credits, so we now have a 0 balance as far as finished goods. And notice also the income statement, it shows that we had $10,000 worth of sales and $4,000 worth of cost of goods sold. Remember, on a multiple step income statement, we have sales less cost of goods sold equals gross margin. So in this case, the gross margin, or the gross profit margin, if you will, either one, would equal $6,000, which is the $10,000 in sales minus our $4,000 of cost of goods sold. Okay, now we're going to do an example and an exercise of the flow of inventory through materials, work in process, and finished goods. And again, I've set the formulas up here in terms of inventory movement and so forth. If you have an exam though, or if you ask questions, you may not have the benefit of having the formula in front of you, so make sure you memorize it. And we're going to see how the formula fits everything together here. Swiss Lodge manufactures chocolate making machines, and during the year the company purchased $2,150,000 of direct materials, in other words raw materials to make the machines with. And out of those raw materials, Swiss Lodge placed $1,800,000 worth of those direct materials into production. So we took those materials out of raw material and placed them into production. We also are told that Swiss's beginning balance in the materials inventory account was $350,000. Now the requirements are, what is the value of the ending raw materials inventory? And then number 2, requirement B, what are the journal entries to record the transactions described? So let's take a look at requirement A here. Okay, we're going to start out with the fact that we had purchased $2,150,000 of direct materials. So if we use our inventory formula, beginning inventory plus input minus output equals ending inventory, we insert the $2,150,000 into the input because that is the materials that we purchased. So that's added to inventory. We're also told that during the accounting period, the Swiss Lodge placed $1,800,000 worth of direct materials into production. So that means they took $1,800,000 worth of materials out of raw materials and moved it into work in process. So what we're going to do is, again, list that $1,800,000, and that is basically our output less value of raw materials transferred to work in process. So now we have two pieces of our inventory formula. Swiss's beginning balance in the materials inventory account, in other words, the beginning of the accounting period, was $350,000. So now we can insert the $350,000 into the inventory account as our beginning inventory. Now if you see, we have $350,000. We're adding the materials that we've purchased. We're subtracting the value of the materials that was transferred into work in progress. Therefore, when we do the math, it's a simple matter of calculating our ending inventory, and our ending inventory in this case is going to be $700,000. So that would be the answer for A. Now let's take a look at requirement B, and I'm going to go over the journal entries that resulted from these transactions. Now normally you'd see a journal entry with a debit and a credit and so forth, and the account and then the dollar amount. What I'm going to do is give you these journal entries in T accounts, so not only can you picture the journal entry, but you can also assess the impact of the debits and credits on the various accounts. So let's go ahead and start out with materials purchased, and that's entry A. So we purchased $2,150,000 worth of materials. What would be the entry? Now we're assuming we're purchasing the materials, everything when we're paying for labor, when we're incurring overhead, when we're purchasing materials, even when we're receiving, when we're making a sale, everything is in cash just to make the entries a little simpler. So the first entry is A, we purchased materials. So we would debit raw materials for $2,150,000, and we would credit cash for the amount that we paid for these materials of $250,000. So you can see the entry in the accounts here. The next item then is the value of raw materials that are transferred to work in process. And in this case, we're going to take the value out of raw materials and transfer it into work in process. Now you'll notice I have for raw materials, I have a BB. That stands for beginning balance, since we really didn't have to make an entry in this case, but I wanted to leave it in that account. We also have a beginning balance of $1 million in work in process. That's for the next slide, but again, that will be a beginning balance in our work in process account. So let's go ahead and do the journal entry to transfer the raw materials into work in process. We do a debit to work in process for $1,800,000, and we credit raw materials for $1,800,000. So at this point now, when we add our debits and credits up, now we have a balance in our raw materials account of $700,000, which, by the way, corresponds to the ending inventory that we computed in our raw materials inventory formula. So now we've completed everything for the raw materials transactions. Let's go on to the next slide and see the description and the requirements in that part of the story problem. Okay, Swiss Lodge had a beginning work in process inventory balance of $1 million. And that $1 million is already written down here, and it was also written in the previous slide. And the reason it's already written is you don't have to make that journal entry. It was a previous value. Okay, as part of the production process, the company transferred $1,800,000 of raw materials into work in process. Now that was from our previous workbook page. You'll notice I've added that amount here. Again, here's our inventory formula: beginning inventory plus our inputs minus our outputs equals ending inventory. So in this case, what I've done is I've already posted the $1,800,000 that I removed out of raw materials and placed it into work in process inventory, because we really did that in the first slide. Also, you can see where I've also recreated that entry from the first slide where I debited work in process for $1,800,000 and I credited raw materials for $1,800,000. Okay, now, during the production process, the company incurred $2 million of direct labor costs and $1,500,000 of indirect inventory cost. In other words, again, indirect product costs. So let's take a look at the amount that we have to record for our direct labor. I'm sorry, before I do that, I'm sorry, I should have also posted Swiss Lodge had a beginning work in process inventory balance of $1 million. So I should have posted that in advance. Sorry about that, my bad for the example. Now let's go to during the production process, the company had incurred $2 million of direct labor costs and $1.5 million of indirect costs. So in this case, I'm going to add my direct labor of $2 million. And I'm also going to add my overhead costs of $1,500,000. Now I need to find any of the production that has been transferred out of work in process inventory into finished goods. So I read on in my problem. Production valued at $5,300,000 was completed and therefore transferred from work in process to finished goods. Then it also says the company also incurred $2.5 million of selling and administrative costs during the period. Let's deal with the $5,300,000 worth of cost in the work in process account that were transferred from work in process to finished goods. So in this case, the $5,300,000 represents the amount that's being transferred out of work in process inventory. So now our inventory formula is complete for calculating the ending inventory for work in process. It's a $1 million plus a $1.8 million, $2 million of direct labor, and $1.5 million worth of overhead. From that, we have to subtract out the value of work in process that was transferred to finished goods, and we subtract out $5,300,000. That means we have an ending inventory when we do all our adds and subtracts of $5,300,000. Now we need to determine the journal entries. So we know what the value of our ending work in process inventory is. Now we're going to do B, where we're going to record the journal entries for the above transactions. And before I do that, what I want to do is point out this last line in the description here. The company also incurred $2,500,000 of selling and administrative costs during the period. Okay, now this is put in as what I call a distractor, because remember, production costs are those costs that go into inventory, and inventory consists of materials, work in process, and finished goods, and those are all on the balance sheet. All those product costs go into inventory. However, selling and administrative costs are considered to be period costs, and those costs are expensed in the income statement as they're incurred during the accounting period. So we do not charge or debit administrative, selling and administrative, or any type of period cost to our inventory. That goes straight to the income statement and is expensed during the period. So now let's go on and take a look at the journal entries that are associated with the work in process inventory movement. Okay, entry A is the cost of the direct labor that was incurred when we were making these products. So the debit would be to work in process inventory for $2 million, and the credit would be to cash, because again we're paying everything in cash. That would be $2 million. Now we're going to take a look at overhead. Overhead cost us $1,500,000. When I say overhead, again, I do mean indirect cost. I'm going to start using overhead and indirect cost. I'm going to refer to them. Even though it's the same thing, I'll refer to overhead and indirect cost periodically because overhead and indirect cost are the same thing. So I want you to get used also to the term overhead. So in this case, overhead or indirect costs was $1,500,000. And this is entry B. So we take a look at entry B. We charge our overhead costs to work in process, again, $1,500,000. And the amount that we paid in cash for our overhead was $1,500,000. Now we need to value or to transfer the value of production to finished goods, and that's going to be entry number C. In the case of entry C, we're going to debit finished goods for $5,300,000, and we're going to credit work in process for $5,300,000. So now if you add the debits up in work in process and the credits up in work in process, now you're going to see that debits exceed credits by $1 million. So we have a debit balance in work in process, which corresponds to our ending inventory balance. Okay, let's take a look at the next slide. And this is, now we're going to trace the flow of our work in process into our finished goods and then sales. So Swiss Lodge, okay, and the requirements again, what is the value of now in this case we don't ask about the value of ending inventory. It's asking what is the value of the inventory transferred to cost of goods sold and the inventory for finished goods. So it asks for two items. It asks for the value of goods transferred to cost of goods sold and ending inventory. So let's go back up to the description here. Swiss Lodge had a beginning inventory of $500,000 of finished goods. So we know we have that beginning inventory. During the year, the company had $5 million in cash sales with a gross profit margin of $60,000. And all these items are the previous entries that we have made in our regarding our last 2 pages of journal entries. Now, I will caution you, there could be a discrepancy between the example I have here versus your workbook where the entries also are entered. You may want to just stop your video just for a minute and verify that all these entries correspond to what you have printed in your workbook. Okay, now again, we're going to start out with our beginning inventory. We're told $500,000 of finished goods. Now the problem is we don't know, we're not told what the value of the goods sold are, but we're given some pretty good hints, pretty good information. Okay, during the year, the company had $5 million in cash sales and a gross profit margin of 60%. So in this case, you not only have to understand your inventory flow, beginning plus input minus output equals ending inventory, you also need to understand a little bit about some of your financial ratios, or at least one financial ratio that you learned about in chapter 14. So remember, when you look at a multiple step income statement, the first three lines are typically your sales, in effect net sales, minus your cost of goods sold equals your gross margin or your gross profit. Now you will remember, okay, that we've seen that in our multiple step income statement. You'll also remember that we calculated what we called a gross profit or gross margin ratio. And the in this case, by the way, we also had, before I go into the calculation, we know we've had $5 million worth of sales. And I'll go back to now to the gross margin, gross profit ratio. Now remember, the gross profit margin ratio or the gross profit ratio or the gross margin ratio, they all mean the same thing. That equals your profit that is remaining after you paid for the cost of goods sold. And we express that as a percentage of sales. I've added of sales of sales. That's obviously incorrect. It's just percentage of sales. So what that's saying is I have $5 million worth of sales. I subtract out my cost of goods sold, and that I end up with my gross margin. And if I want to calculate my gross margin, it would be that amount divided by my total sales. So with this information here, I know I have $5 million worth of sales, and I know I have a 60% gross profit margin. So that means 60% of my sales are left over after I paid for my cost of goods sold. So what I know is that my gross margin had to be $3 million. So I'm going to put that in there. There's my gross profit. And if you take $3 million divided by 5 million, that equals 60%. Now it's a very simple matter now of calculating cost of goods sold, because we know sales minus cost of goods sold equals gross margin. So we know in order to, if we start out with $5 million worth of sales, we're going to have to subtract out $2 million to get to $3 million worth of gross profit or gross margin. So now we know the value of goods sold, and we can insert our value of goods sold, which are $2 million, into our finished goods inventory movement formula. And now it's a matter of doing the math. $500,000 plus $5,300,000 minus the $2 million that we computed as value of the goods sold, and we end up with a total ending inventory now of $3,800,000. So now what we're going to do is go ahead and reproduce the journal entries as a result of this inventory movement. So let's start off with entry A. And this is recording our cash sales. So in this case, I'm going to use entry A, and I'm going to record debit cash for $5 million. That represents my sales. And then the next part of my entry is credit to sales for $5 million. Now the second part of the entry is transferring the value of my inventory, which is $2 million, to cost of goods sold. So in this case, I'm going to go ahead and do my entry for item number B. I'm going to debit cost of goods sold for $2 million, and I'm going to credit finished goods for $2 million. So when I add my debits and credits up under finished goods, that's $3,800,000. And again, you can see my sales are 5 million minus my cost of sales, which would be 2 million. And if I subtract my sales from my cost of sales, just like I did up here, my gross margin would be $3 million. Okay, and with that, That is the end of our class presentation. When we do these and I just run through the videos, they tend to go fairly quickly. So anyhow, if you have any questions, you can bring them up in our next class, or feel free to write or call me again if you need to talk to me, 970-227-3179. And I'll see you in our next class.